this is the part of the show where I talk about what I believe individual investors need to focus their attention, where they need to focus their attention before they make their investment decisions over the next 1 to 2 weeks, 5 to 10 business days. The first thing I'm going to say, and you probably would guess, is we need to keep an eye on the inflation rate. We just received the most latest June data out of the United States showing an increase in inflation all the way above 9%, the highest we've seen since the early 80s. That is definitely not going to make or get the Federal Reserve to slow down their interest rate hiking policy. In Canada, we tend to be a little bit further behind. We tend to tell our Bank of Canada tends to get the inflationary data a few months behind the United States. So we're still looking at inflationary data from the last few months. So as that starts to come in, and depending on what those numbers are, that's going to dictate what the central banks are doing with regards to interest rates. So I think we need to keep one eye on inflation. A second thing that individual investors need to focus on going forward is other economic data. Data like the 10-year government bond rate. As interest rates move higher, the 10-year government bond rate moves higher with it. So right now, 10-year bond rates in the United States are trading in and around 3%, now slightly higher. In Canada, our bond rates are a little bit higher than that. We're probably in that 3.10, 3.15 range. But overall, as interest rates rise, as central banks increase their rates that they're charging banks, prime rate or overall interest rates will rise with it. And that includes the 10-year government bond rate, the 5-year government bond rate. And so one of the things you may hear on TV and some of the experts speak about is sort of the yield curve. You know, what's going on with the yield curve? Normally, when we look at interest rates, the 10-year rate is probably higher than the 5-year rate, the 5-year higher than the 2-year rate, et cetera, et cetera. If you go out and buy a GIC, you expect that if you're locking in your money for 5 years, you should earn a higher interest rate than if you did it for just 1 year. Right now, what's going on is the 1-year rate, or in this case, the 2-year rates are actually higher than the 10-year rate. So we say the yield curve is inverted or upside down. It's not working like it's supposed to. And that, unfortunately, tends to signal more often than not that a recession could be coming in the next 6 to 12 months. So keep an eye on the 10-year government bond rates. Let's see if they're getting back to normal, where the longer rates are paying higher interest than the shorter ones, or is it still inverted? And let's keep an eye on how high these rates can go. A third thing that I believe you should keep an eye on over the next 1 to 2 weeks is the price of oil. We've seen the price of oil fall significantly over the last, let's call it week or so. It was trading well above $100 a barrel, and now we're into that $95 a barrel range. Unfortunately, I think the price of oil has fallen for the wrong reason. I think it's fallen because we're seeing some of the demand or some of the growth coming out of really places like China, United States, and other places around the world start to slow down. And when we see or believe that there's going to be a slowdown, China perhaps maybe going back into a lockdown in some areas due to COVID. They have a zero COVID policy, and we're starting to see COVID start to show some higher numbers with respect to people having COVID in China. So they're starting to shut certain cities down in China, and that's not good for demand, being the second largest economy in the world. So overall, we're seeing the price of oil fall because perhaps the demand is falling. But I think that will be just temporary, and eventually China will reopen again and the demand will spike a lot higher and oil prices will probably move higher again. What we want to see is oil fall because we have more supply. We need more supply of oil. We need more supply from the United States. We need more supply from the OPEC nations to make up for the lost barrels of oil that we are no longer using from Russia due to the invasion of Ukraine. So those are the three things I think we need to focus on. We need to focus on the 10-year government bond rate. We need to focus on oil prices. And sorry, the third thing is GDP. I almost forgot that one, probably the most important one. GDP is the third thing I think you need to focus on. We're going to get a GDP reading or a growth reading out of the United States. That's going to happen in the next few weeks. Is the United States in a recession? If we see a negative number, a GDP number, or a negative growth number out of the US, that will be the second negative number in a row, second quarter in a row of negative growth and that will signal a recession in the United States. So we need to keep an eye on where GDP or growth is out of the US and in Canada as well. Canada has just taken down our growth numbers down to, in the 3% range for this year and as low as 1.5% next year. So everyone's taking down their numbers. They're taking their numbers down for their growth expectations. So we need to keep an eye on these GDP numbers going forward as well.